Good morning or good afternoon, depending on which side of the country you're joining us from. Thank you, everyone, for joining us here for one of my favorite webinars of the year, industry update for planning and budgeting. It's a great conversation we have here. Really excited. We have our normal cast of characters to join me on this wonderful conversation today. So to kick things off, I want to introduce the panel with me today. I'm Charlie McQueen, President McQueen Financial. I'm joined with Craig Cecilia, our Chief Investment Officer and Managing Director. Craig, how are you doing today?
Hey, I'm doing fantastic. Thanks for having me and welcome everybody.
Cool, thank you, Craig. And I'm sure we're going to talk about good-looking yield curves today. That's our typical topic when you're on the call.
We gotta love the yield curve. It's very intuitive.
We also have Heather Shepley, our Vice President and ALM Director here today. Heather, thank you for joining us.
Thanks for having me. Looking forward to a great conversation. It's a fun thing to talk about today.
It is best. It is fun. And also, last but not least, Dan, you're at the bottom of the stacked pictures on my screen, but thank you for joining us today. Dan Martin is a senior consultant and responsible for all of our valuation and transaction activities. Dan, thank you for joining us.
Yeah, thanks for having me. I look forward to the conversation and welcome everyone.
Yeah, so today we're going to have a great interactive conversation on a bunch of different topics, and really here to give you some good thoughts and advice for what is coming for 2023. And just a little housekeeping before we kick in here. If you have any questions, feel free to click on the Q&A button. If you go to the top of your screen, it should pop down. We'll answer the question along the way, or if it makes sense, or at the end if it makes more sense. Also, today's webinar, like all of our webinars, is recorded and will be on our YouTube channel. Please reach out to your advisor for a copy of it. They'd love to share it and probably have a little fun with us in it. So with that, today we're going to hit on a number of things. We're going to kick off with the topic of the day, inflation. We're going to talk about an economic update, our interest rate projections, get into the ALM world, deposits, loans, non-interest income, talk about investments and what's happening in that world, and then get into the transaction advisory merger activity. So again, please, along the way, feel free to ask questions and throw it in here. We've got a lot of great material today, and I would love to see if we can add a little more to it to make things a little bit better for your specific questions. So with that, this is the question of the day, I guess. This is the top of mind. This is what we see on TV every morning and every night. Inflation is running a bit hot. One would say a little higher than expected. A couple things here. The thing that the Fed pays attention to is the red line, which is the personal consumption expenditure core index, running at roughly 5%. We usually talk about X food and energy as the next one that we pay more attention to. It's around 6 and 6.3. But the core inflation, everything, is running at 8.3. The hard part is last time I checked, we all put gas in our cars and we all put food in our plates. And so, the inflation with food and energy is definitely hurting Americans. It's taking away spending capacity in other spots. But, inflation is definitely going faster than what's wanted, and the Fed has resulted in raising rates quite a bit. Craig, do you see inflation starting to peak out here with these bumps, or is this a false hope that it's come down a little bit with core inflation because it has come up with X food and energy?
Well, I just want to make sure that we all understand the definition of transitory before we get into this, right?
I thought transitory was removed from the dictionary.
Exactly. You look it up and you'll see a picture of Powell in the dictionary in Webster's. Inflation is a lot higher than we thought, and been higher for a longer period of time than the whole world thought. We can all agree on that, right?
Yeah, oh, absolutely.
Yeah, and we are seeing a little bit of ease going on right now. And our core here that we have, Charlie, you mentioned the core PCE with their preferred method. It strips out that energy, but even in the energy, which really is impactful and important to talk about because it impacts all of us here on the call as well as all the businesses globally, is that we're starting to see some ease there. But we are seeing some easing on this, and we're also seeing, as we go through a couple of other slides, just an easing of the economy and the economic expansion.
Yeah, so we're seeing an easing of the economic activities, maybe a slight reduction in some costs, but not across the board. Is that a good summation of that comment?
Yep, I think it's very good, and you got to expect everything doesn't turn all on the dime, right? It comes in lockstep and how things start to get impacted or eased up on.
Yeah, and I do think we're seeing that, but one of the spots where we're not seeing it yet is energy prices. We've been seeing a bit of the opposite. Now, gasoline and oil prices have been coming down. Actually, the longest streak of coming down for 100 straight days. Now they've bumped back up this last week.
Yeah.
But we are seeing something really interesting with energy prices. Electric prices, talking about electric costs, and electric costs have skyrocketed. We all hear the stories in California, the grid failing and brownouts and blackouts. But we're beginning to hear more and more conversations about that in the Northeast. We're shipping a lot of gas or diesel and natural gas over to Europe. Now we're beginning to see energy prices spike quite a bit in the Northeast. And this is something that's got me a little bit concerned about how much energy is going to cost people going forward.
It'll be definitely an impact to disposable income, and at being the consumer is almighty, meaning driving a huge percentage of the economy. And if their disposable income is impacted by one of the major things that everybody experiences, i.e., energy, it's going to be very impactful.
Yeah. Just something to remember here. If we go back from the 90s to 2000 or 80 through 2000, we had very little change in energy prices, and since then they've doubled. 1 in 6 Americans is delinquent on one form or delinquent on some form of utility payments right now. So some pretty big numbers there. Well, shifting here, because that backdrop's really important, that we see inflation's high, it may start to coming down. We are seeing some pricing coming down, but the Fed has reacted very, very strongly here. And we went for what Craig calls a good-looking yield curve here, December of 2012, to what we call an inverted yield curve here today. With short-term yields higher than long-term yields. And the little tail here, I'd say, is getting pushed up as the Fed raises rates. But usually that's an indicator that the Fed's getting close to breaking the economy. Does that make sense, Greg?
Yeah, absolutely. And and I do love that bottom curve. It is an absolutely gorgeous yield curve that we've experienced, that we had for such a long period of time. And when you do have an environment where rates are going up, the overnight lending rate that the Fed is manipulating or targeting, sorry to use that word.
One and the same.
When you talk about government, right? You're going to see that the belly of the curve that overnights out to call it 3 years is going to have the most movement in going up, and you can see that how it's come inverted. And just an interesting point is this curve has been inverted since July. So that's a long period of time of having an inverted curve for 3 months, right? And that just means that we do have a recession coming around the corner. And the Fed, though, is not going to stop until they do get this inflation number under control. And so it'll impact that shorter end of the curve more than any part of the curve over the next quarter and a half, 2 quarters.
Yeah. So the Fed raises rates to break the economy, and the market says, hey, I don't need to have as high of interest rates further out because they're going to break the economy and things are going to slow down. So it's making all the correct shapes there. One thing is we head to ALM in a couple of minutes. You'll see here the change in the 3-year Treasury up 372 basis points, 2-year Treasury 382 basis points. In the last 6 months, we've seen the Fed funds rate shock up 300 basis points. So we get to ALM, man, those plus minus 300, 400, 500 basis points seem to be a lot more important today as we go forward. So one of my favorite graphs, which if you've seen any of my presentations, I always throw this graph in here because I love it. We have the Fed funds rate in red, the 10-year Treasury is the black dotted line, the 2-year Treasury is the blue dotted line. As Craig mentioned, we get to these spots where we invert, we stay inverted for a little bit, and then we come down because we enter a recession. We didn't quite do that in 18, 19, 20. That was the Fed raising rates because the economy was strong, but not overheating, and trying to normalize rates was the term they used back then. But here you can see the rocket ship, the Falcon Heavy going straight up here with rates. And the Fed appears to have been behind quite a bit and slowly catching up to what the market thinks. You like the analogy of a rocket ship, Greg?
Yeah, I wouldn't have thought of that myself, but now that you're using it, do you mind if I borrow that?
All yours, all yours.
Thank you.
All right, so definitely a big reaction makes you think that we're probably going to see this inversion over a period of time, and then probably the Fed cutting rates. There's some interesting things going on with unemployment. I'm pretty surprised it's still so low. Are you?
Actually, yes. And I do think we're going to have a lot of change to this chart as we go over through the fourth quarter and into the first quarter of 2023. We're seeing it across many industries, manufacturing being a very big one where we're starting to see cutbacks, and it's just going to be really impactful. And that's kind of one of the things that we're going to have to be the catalyst for the Fed and their consideration for pivoting what they're doing, right? Is
Correct.
two mandates: full employment and inflation, price stability.
Price stability, yeah.
So as they start to see impacts to employment, it's going to get slowly but surely increase the probability of a pivot, or at least a pause at some point in time.
Yep. There are some interesting demographic backgrounds here that come into play, such as Gen X being much smaller than baby boomers, and millennials, which are big, but they're still coming along in numbers. So we do also have a little bit of a reduction of people with lacking immigration policy in the country for 10 years, I'll say, just to blame both political parties. But we are definitely seeing a lower number of people wanting to work. And we talk a lot about the participation rate being low. Copping over to housing, housing prices, it appears that the increase is slowed, if not stopped, in a lot of markets. We're definitely seeing some affordability problems there. And I do expect that that's going to cause people to be a bit nervous about where we are and where we're going to be with housing prices going forward. Affordability is going to be really tough when to buy a house of any size given a 7% mortgage rate.
Yeah, I tend to agree with you on that. And as long as we do have the rates in mortgage lending being high, we're going to see this stall of appreciation. And the other thing that we see is the interest rates and the affordability in all asset classes, like autos. They had a statistic coming out where the majority, I can't remember if it's 30% of auto loans are at $1,000 payment. It's just or $800 payment. Just amazing to me. 16% at 1,000.
Yeah, that was a huge number, and it's gone up from like 3% 3 years ago. So just the dollar amount of the payments is just huge.
Right.
Along with that, the wealth effect comes into play as the stock market has come down quite a bit. We're getting darn close to the high point right before the pandemic, where the world fell apart. But we're definitely seeing a pretty big reversal here, which makes people feel less wealthy, which will also curtail spending, which is one of the components that puts you into a recession.
Before we wrap up the economic side, because I know we got to move into our next section, is something you had said the other day, Charlie, really does ring true, is, how far is the stock market going to decline, right? We had a couple of days positives of positive stock market price changes this week. Today it's offsetting a little, but as long as the Fed is signaling and acting on rising interest rates, we still have a little bit of room for on the downside on the stock market. We can't judge the bottom, but there is potential for a slight decrease as long as rates are being raised up, and then we'll start to see flattening to increasing once their pivot takes place.
Yeah, it's a great point. We're going to talk about quantitative tightening, which is different than quantitative easing, which we used to talk about, and how that's also modifying the market a bit. But here we are. We're talking about some really, really flat predictions here, but higher predictions. And what we have here is the FOMC dates implied rates, and this is the betting in the Fed funds market. November of 22 here, the next meeting coming up, looking at going to 4%, then 4.25%, then 4.50. In February of next year. At that point, it's capping out. It's looking like maybe we start to see things come down here in November. We usually agree with the direction, not the severity of this curve. Is that a fair way of saying it?
It's a fair way, and we're getting pretty close to the end. So, we might get a little bit closer to what the markets are saying now that we're getting, because there's a little less for wiggle room, quite frankly, as we get closer to where the pivot's going to take place. But yeah, definitely we do see a couple of rate increases between now and the flattening that takes place in the first quarter.
All Heather's thinking in the back of her mind right now is, oh my gosh, that would be 400 basis point increase in Fed funds in 1 year. Thank goodness we do 3, 4, and 500 basis point standard in our reporting. You put this chart in here. What in the world is this chart?
So briefly on it, I wanted to really show and demonstrate, what the sentiment is. We know what the sentiment is for the consumer. We don't also always talk about what's going on in the business world. And this is for manufacturing new orders. And I wanted to give you a little bit of a comparison of where we were and where we're at. You can see that right side of the chart for since 2021, we're slowly coming down here, and we are slowing down. And this kind of is going to go right in and segue into what we talked about earlier, is employment and jobs, and just the slowing of the economy that's taking place right now.
Yep. 2 quarters of negative GDP growth equals a recession. Unless you want to get reelected, then it might not be a recession.
Yeah.
All right. Hopping in here with some projections. We've got some great projections here. We've got our Fed funds rate as a top line, topping out at 475. SOFR, I love SOFR, 450. Prime, obviously, to 775 right on top of that. 2-year Treasury, wow, all the way up to 530.
Yeah, that's where we're talking about what part of that curve is really going to be impacted in the short term while these last few Fed's rate meetings take place. And it's going to be that belly of the curve there. You can see like the flattening. The 5-year and a 10-year don't go up quite as much in our minds.
Yep. All right, 10-year Treasury not nearly as much, up to 450. We've got a few quarters of negative GDP growth and 0, then back to a little normal. And the consumer price index moderately slowing, but still high. But we're talking, and we're getting closer to 470, and at some point here, even at 440, that's interesting. The Fed will start to lower rates, so they're going to get used to a little higher inflation.
Right, and you'll see the longer end starting to react a little bit more than the shorter term. So you'll see a little bit of the spreads between, say, 2s and 10s widening, but then contracting quite a bit from a year out from now, as well as like the 2-year the Fed funds as well. So a lot of changes in the curves.
Yep. So I do think for all of our listeners out there today, what's going to happen here is we're going to see rates continue to drift up. Then we're going to get to a high point. We think that high point is somewhere around year-end, first quarter of next year. And then we're going to slowly see a reversal and come back down. So not a bad time to talk about lengthening duration and being prepared. Also makes you think carefully about your borrowing strategies and what you're doing with your interest rate risk position, because that's really the key here. Now we've got a prediction, and we've been fairly consistent that prediction that rates would end up topping out somewhere around year-end this year for the last 6 or 8 months. So now what are the next steps we should do, and how should we look at things in our ALM report? So thank you, Craig. I appreciate your update on interest rates.
Oh, you're welcome. It was enjoyable.
All right, Heather, welcome again. And kicking off the ALM deposits. I mentioned earlier we talk more about quantitative tightening, but what we're showing here is the fishing line laying in the water, then the hook on the end. And the hook, here's the line, which is the normal growth of money supply, and then where the world fell apart, and the hook that's getting us right now. And we have I don't think we've ever seen a full year of negative, someone told me this earlier, we've not seen a full year of negative M2, money supply growth, ever. And this is the biggest reduction of money supply we've ever seen. Now, we did have this massive shoot up of money put into the system through our stimulus, but this is cash going away. Heather, we seeing any changes in cash at our clients' balance sheets?
Oh, absolutely. With the disposable income really reducing because of all of our overhead, it's giving us less and less. And for a long time, we had deposits coming in faster than we could possibly handle. And almost as quickly as that's happened, we're starting to see the opposite begin to occur. We're seeing deposits run out the door left and right. And as that continues to happen, we're really having to make sure that we're paying attention to what our cost looks like. What do we have to do to be able to maintain these deposits and sustain a good margin position? But the tightening of deposits and liquidity has definitely become a very big concern. And that's happened very, very quickly, a lot faster than we ever were prepared for.
Yes, we're seeing here the largest reduction of deposits in the banking market is FDIC data, $370 billion out in 1 quarter. It's interesting, though, we look at the size of these inflows, which makes us think, gosh, maybe we should be ready for more of these. Look at the size of these inflows we had back here with all the stimulus payments. Definitely going to make things tough here. We're seeing deposits go. And one of the things as we look at projections for 2023, I was quoted at a meeting the other day of letting people, my comment was that if you have a positive deposit growth, you'll be a unicorn next year. And most people are going to end up, I think, with 3 to 4. And so you can even look at putting as 5% as your budget, negative 5% deposit growth. That might not be a bad spot.
No, not at all. And, for some, seeing some of those deposits run out isn't necessarily a bad thing, as we did see equity positions really start to kind of get diluted. So some of that, but at the same time, being concerned that those deposits are running off too fast and not having enough liquidity to, be able to continue to lend is really our biggest concern at this point. So looking at our pricing structure and making sure we're doing the right things is going to be very important going into this next year.
Yeah, this is an interesting chart here. I'll just quickly touch on. We have a share growth at credit unions way up at 25% a year and now plummeting down quickly. Yeah. Loan growth up at 16%, and it doesn't take too many quarters of 8% delta of that you're going to run out of cash pretty quick. And so we are seeing dollars go out the door pretty quick.
Yeah, very fast.
Yeah. Another one that was interesting, asset growth versus membership growth. Membership growth has been effectively unchanged, but the key here is that asset growth has been huge, and we're probably going to see some of those things change here as they continue to start going out the door, or continue to go out the door. All right, so going from deposits, simpler conversation, to a much more complex conversation on lending. I know, Heather, the thing that you're most excited about is that CECL is live on Jan 1 of 2023. We had to talk about this briefly. You must have a December 31, 22 CECL report because you need that for the CECL transition amount. What this is going to do also is it's going to make people think carefully about what rate they're booking loans at. As you book loans, you need to make sure that you're thinking about that CECL reserve that you need to put on there. So as risk goes up in lending, your CECL amount is going to go up immediately. So looking at rates will be really careful, really important here as we go forward.
Yeah, CECL is definitely going to have to be the forefront of that thought process and conversation, and making sure that we're putting the right types of loans on our balance sheet, knowing that we're going to see some increases and upticks in delinquency.
Well, and speaking of that, what do we have here? We got not that much growth in loans, although it's starting to kick up after a number of low years, right?
Yeah, finally actually starting to see a little bit of that demand come in, and some of that, goes right back to our deposit position and that extra, liquid income that we were seeing, instead of having all of this cash and seeing consumers paying off debt and holding on to that. They weren't having to borrow. Now we're getting back to that position where they don't have those extra funds and they're starting to need that demand on that borrowing side again, seeing a growth in credit card balances, and just that need is there. So from a financial institution perspective, this is our opportunity to make sure that we're taking advantage of the loans that our opportunities are, but then also making sure we're pricing them appropriately based off of the risk that we're expecting to see.
I love that conversation on pricing. And if we look here, and we'll hit that right now, but before we get there, banks have not seen that large of loan growth here at all over the past few years. And if we look at credit union side of the world, massive growth in the last year in used auto and new auto, 17% and 14%. So really, really big growth. And one of the things the credit industry is really struggling with is an oversupply of auto loans. Starting as interesting with Craig's comments earlier about the price of auto loans and what payments are. But we've seen twice a normal quarter growth of loan growth here. So something really to go back to pricing, and Heather said, and we're going to hit on pricing in just a couple more slides, because we're also seeing the mortgage world. Things are really dropping like a rock in mortgages. We talk about, here's a picture of the 10-year Treasury. You've got to go back 20 years to actually find a spot where the 10-year Treasury was higher. So you're not going to find many mortgages higher. Affordability is tough, and I think this is another neat chart that we had put up here, which is looking at the refinance index, and we're at the lowest level of mortgage refinances for over 23 years now.
Yeah, we've seen this run down so quickly simply because of that large increase in the expense side of the yields on these products. But the other side of this is seeing so many consumers deciding to take advantage of the equity that's in their homes. They don't want to refinance their first mortgage. It's too expensive to do so, but they are sitting on a lot of value in their homes. So what they want to do is put that money back in, remodel the kitchen, upgrade your bathroom, do what we can to, put that value back in and not have to move and take on a much higher expense on a new home. So there's definitely some equity opportunities there on the lending side, at least from the mortgage perspective.
I think that's a really good point, Heather. As we think about where we're going to see loan growth, it's not going to be in mortgages. It's in general, it might be in some ARMs and different things, but it can be in fixed home equities, floating home equities as people are going to update homes.
Absolutely.
We're also seeing new home sales really start to come down substantially. I heard a rumor about builders offering discounts on houses, which is something we never expect we'd hear in this market, but it's going to be tough to see the new home sales go anywhere for a while. We've mentioned auto lending a little bit. I know this is something that's near and dear to a number of people's hearts, but this is really amazing to me. The Manheim used car index is effectively double where it was just a couple of years back. Now it is starting to come down quite a bit, or a quick drop here, or massive decline, one would say, depending if you're reading a website or looking at real numbers, but a bit of a decline here. I think one of the things that we want to get across here at this point is people have made if we look back at history, interest rates were moving so slowly that changing loan rates did not have to happen that frequently. Now that we're seeing massive swings of interest rates, loan values, all sorts of things, we need to update our lending on a more frequent basis. Does that make sense, Heather?
Absolutely. We have to be at the point where we are responding with the market, and the speed of that has significantly changed. So we have to be reviewing these often, and we have to be taking in everything that's going on around us to keep up with what's going on and not put ourselves in a position where it's actually going to cost us money.
Yeah. One of the things, just simple pricing conversation, if we go back and use a risk-free rate today of 4.25, you can buy a 3-year treasury pretty close to 4.25. The dealer reserve, people are out there, we can do 50 basis points a year. These loans tend to last 2 years, 100 basis points. CECL reserve, 1%. We're seeing 2022 production at a 1% delinquency rate, so it's probably not too far off. And then what's our targeted return? What return over our ROA do we want? We could also talk about risk pricing and pricing for time of people doing the work. So at a minimum, as I look at this, 4.25 plus 50 plus 1 plus 1, we're to 675 as a base rate for auto pricing today. We see a lot of people still in the 4s and 5s, and I think a lot of time needs to be spent on updating this pricing.
It is time.
So remember, market participants are changing. People are exiting lending markets. Values change, forecasts lost. And this is the same thing with mortgages. We're seeing a lot of things modify here. Any final comments on pricing, Heather?
No, I think you pretty much covered it. I mean, the biggest focus point is making sure you're as up to date of what's currently going on and making sure we're reflecting that in our offering rates.
Yeah, really, really important. Well, another component of ALM is profitability, I'd call it, but we go to non-interest income. What are you seeing from Heather, non-interest income activities? We have our standard list here of brokerage, SBA, insurance, debit, credit card activities, mortgage. Are you seeing any growth or contraction in any of these areas?
Definitely much more contraction here. We're not seeing as many mortgages going through the door. This is one of the largest pieces that we saw on so many balance sheets on that income, that fee income based off of those products. And as those are becoming less and less of a demand, that non-interest income side is becoming a little bit more difficult. So that's definitely something to review and ensure that you keep those things moving forward, whether you're doing it on transactional fee income. We need to be able to make up for some of that lost value that we're seeing on the offset because of yields.
Yeah, I think it's a great point. We are seeing, again, as I think Heather said it really well, mortgages declining, obviously, in the gain on sale. Brokerage, we're seeing a little bit slower as people are not investing as much at the moment, given the market. But one of the things that I encourage everyone to look at is SBA lending is a great spot. And I think having some sort of SBA lending out there, if you have credits, maybe you're just not an expert in that area, but you want to put it out there. I think it's a good spot where you can make some nice fee income, and so it's an area people should be looking at. All right. Well, Heather, I think as we reflect back on the ALM situation, deposits are going to be tough to get. We should, raise our rates to the least amount possible. From there, lending, it's going to be tough. It's going to be tough. Car lending's going fast, but that's about it, right?
Yeah, just making sure that we're trying to balance this liquidity as much as possible. Pricing everything appropriately for our balance sheet is going to be the most important part. So take advantage of where your opportunities are and make sure we're in a good spot.
Wonderful. I appreciate that, Heather. A lot of changes coming on. ALM is obviously always super important, but it's going to be extremely important in 2023 with all these interest rate changes, making sure we're pricing loans correctly, pricing deposits correctly, looking at borrowing strategies, really making sure we're talking about optionality and non-optionality. And we're going to talk quite a bit about that here in the next section, investment portfolio management. And before we go there, we did have a quick question that came in going back to our loan pricing at 675. What term was that for? And we'd say that's for a 60-month type number. That would be a rough par number to start with. But that's something just to start thinking of. We're seeing where a lot of people are saying that a base rate for the 70, 80-month loans is definitely in the 7s and 8s today. So interesting conversations on loan pricing. So that the example we did was for roughly a 5-year term. Okay, thank you, Heather.
Thank you.
All right, Craig, hopping back, talk a little bit with you, investment portfolio management. I was thinking of the word negative convexity, one of my favorite words in the world a moment ago, which I couldn't think of. But what's going on in the investment portfolio world?
Well, one of the things I like to really think about and send messages to is we all have fixed income portfolios, and the impact of, as you see this 10-year Treasury surge, has been on the market values of existing portfolios and the OCI, and it's going to come back. Right, as we project, forecast interest rates as well as the Fed, there was going to be a pivot point. Rates are going to come back down. We're going to have some recapture of some unrealized losses that are going to come back. So I want to make sure we send out a message that things aren't going to be as bad as people think. And when you're talking to your board members, kind of just talk to, hey, we've got fixed income. It's not a credit event. It's more of an interest rate cycle that we're in. We have fixed rate maturities. It'll all return. So just want to make sure that everybody, gets a reaffirm. It's going to be okay. But we've had this tremendous increase in interest rates. When's the last time you've seen the 10-year pop that much in that short a period of time? It's been impactful. I'd have to say never, really, in such a short period of time. So it's a fun time right now, especially for institutions that have money. It's a great time to be looking at booking assets right now in the investment portfolio. We really got to key in on what type of investments without that negative convexity, because when the worm turns, the Fed pivots, rates start to come down a little bit, a mortgage that's here today is going to be a mortgage that's going to be gone in 18 months from now. It will be refinanced. That whole market will resurge again. And so you want to look at investments that are not callable, don't have negative convexity, that we can really appreciate the higher rates that we book now for a long period of time when rates come back down. Does that make sense?
When the worm will turn makes perfect sense to me. I love that analogy there. No, I do think it makes a lot of sense, Greg, and we're gonna see this change. You don't come up that much without something coming down. You can look at history here. It does change, and now we do have this unique event with inflation, but inflation will get under control. The question is when and how long. I do think another valid point you put out there was when we had a $3 million gain in our investment portfolio a year ago. We didn't sell it and take the gain, and now we're at a $3 million loss. We're not going to sell it and take the loss. We've got a good duration, a good laddered portfolio, and we'll keep moving forward. Okay.
Right.
All right. You've got some corporate debt stuff here. CDS. Was that a dental term? What is that?
Well, let me just say, everybody should floss twice a day, okay? Just to bring out that. But yeah, credit default swaps is one of the great tools that we utilize to look at what is probability of a default on debt. And we didn't drill down for this presentation a bunch of individual companies or securities, but this is a chart of the average 5-year debt that is issued by US companies and the probability of default, or what it costs to insure against default. And I've got 2 lines in there, and you can see I can't read the numbers right now because I don't have my glasses on, but we're currently about 107. Is that right?
That is correct.
Yep. And then the average was for the last 5 years has been about in this low 60s.
62.
Thank you. So we're almost double what the average has been for the last 5 years of what it costs to insure against defaulting on high grade. And the high grade means AA rated corporate debt. And it's just a sign of the cycle that we're going through. But it really is going to segue into where we're starting to see value in the markets across various asset classes, because the economy is turning. People are expecting to have some stresses in the market. You know, when you have a turn of a recession or the signs of that, that's when you get at the end of this cycle is when you start to have higher defaults, and that's why it's been spiking a little bit.
So what you're telling me is when the default rate goes up, the expected default rate / the cost to insure against a default goes up, the spread should widen, and therefore corporate bonds should be cheaper, higher yielding to buy.
Correct.
Love it. I followed that path.
Thanks.
All right. Now, this looks like a hurricane path here. You got the spaghetti going on over here.
Okay, well, it might be a little too soon, but let's just go with that here. Yeah, so this is a great demonstration or illustration of what I mean here. And there's a lot of pretty colors here. And the top light blue line is single A corporates. And where I really want to focus in on is that line, if you can put your laser beam on the 5-year line there, and kind of being a very general part of the curve where everybody plays in. Either you play through it or right up to the tip of it. But right there, you can see the really big difference in spreads amongst different asset classes. The bottom where you're at is the riskless trade. Just under 4% is a treasury. And then you're going up from there is the most common things for our audience is agency debt. And then and for banks, it'd be bank qualifieds. But really the big benefit right now is coming in the taxable market, and that's in taxable municipals right there. And that pea green color, that's a wonderful rate. And then the top one being corporates. And when you get to a spread of 80 to 110 basis points over riskless assets, you're starting to see a little bit of value into a asset class where if you get back to the period where we had low and long or low interest rates for a long period of time, you know, those spreads could have been anywhere from 10 to 30 basis points. So it's really widened out, and those expectations on that credit default swaps is one of those reasons. In addition to relative nature, as rates go up, you generally do get a widening of spreads. So, you know, we've never been a huge component to say always go with corporate. We like to take corporate risk in a lending portfolio, one, because you get paid more, but now we're starting to see a little bit of value in that asset class, quite a bit more so than we have been.
Well, I really appreciate those comments, because you think about where we are, even if you don't want to go down the corporate level and you want to go on the muni level, you know, munis are yielding 472 roughly here in the 5-year time frame. And that goes back to that conversation about lending. You know, with the muni, most likely don't need a CECL number, although we'll be talking CECL and investments a lot with people here soon and making sure we're all planning ahead. But the loss history on AA and AAA munis is extremely limited. So we wouldn't expect a loss there ever. But when you start to compare this to going over to a lending number, you know, you got to start thinking about that spread. I need to get compensated over the risk-free rate to make sure that I'm allocating my assets correctly.
Yeah, well said. And there is a deliberate process to introduce that credit or that credit risk to your balance sheet. and making sure you really do have a good credit process for your investment portfolio that has credit related corporates or taxable municipals is paramount to make sure that you can't eliminate risk. What you do is you manage your risk, and like you said, Charlie, there's been very limited, if any, in the municipals default world, and the corporates are extremely limited as well. So it's pretty easy to go down that path to book some of these spreads without callable options, so you can lock in these nice yields a long period of time.
Well, I appreciate talking about yields and credit there on the municipal and corporate side. Negative convexity you've hit on quite a bit, and which makes me happy, because we are going to see rates go down. And if you're putting on a lot of loans, mortgage loans, putting on a lot of mortgage type investments or callable investments, when rates go down, you're going to get your portfolio called. And the hard part about this is that's when earnings are going to be tough. Thinking about the ALM section with Heather, we've been in a good earnings time here for the past year as interest rates come up, margins are strong, deposit yields are still low. Now, as we enter this inverted yield curve phase, we're going to see loan yields high, investment yields high, and deposit rates start to come up, but we still have good credit. It's when a recession is here, the Feds raise rates too much, they start to bring them down. That's when we have credit losses, and then we have our assets being called away to lower yielding assets, and that's really the tougher spot. So today is a great day to really plan ahead for this potential change coming up. With that, Craig, any other comments in the investment world you'd like to share?
No, I think we covered it very well, and good summation with respect to strategy going forward into the new year.
Cool. Well, thank you. You and your credit team have done an amazing job. Great credit write-ups. One of the wonderful things that we provide here for our clients is quarterly reviewed, but whenever there's a data point comes out, information comes out, usually it's a yearly activity. You get a brand new credit write-up, which has our credit rating, our own internal credit rating, along with a credit rating agencies. Really good data to make sure that your bonds are not in a bad position. And one thing, if you look back at the history of bond investing or fixed income investing, is if a credit starts to fall apart, the right thing to do is to sell it quickly. And that's something your team does a wonderful job making sure we're never in that position. So thank you very much.
Yep, you're welcome. Thank you.
All right, Dan, we didn't forget about you yet. You're not at the bottom of my screen anymore. You moved up a notch, I guess, because maybe that's because you're talking now. But thank you for joining us here. We're going to talk a bit about strategic activities and merger valuations and transaction advisory. And you threw me for a loop here. You're talking about strategic planning first. What's going on here?
Yeah, so I think the big thing in kind of what Craig covered on investment advice and where we should be looking, kind of where Heather was covering with ALM and balance sheet management and how we should be structuring for our environment. I think another thing that often gets overlooked is, what is our plan for growth, right? Are we comfortable with our own internal growth? Or do we have a plan to be able to take advantage of opportunities that may present themselves in a marketplace? And so I think having that consideration or thinking about that going into year end, really have a couple things to touch on that you really should be thinking of. One, what is the environment we're operating in? I think understanding that really can give you some good direction in, what type of goals you may want to set in regards to this type of strategy. And then second to that is really, you got to define your goals. So what do you want to do? What is the outcome you're seeking to achieve? Are we looking for deposit growth? Are we looking for liquidity? What are we trying to achieve? And then ultimately determine how we can achieve that. Are there organic growth opportunities within our institution, or do we have to seek opportunities outside of that?
It's important. You've got to have your goals. And this is what we're talking about right now, is budgeting and planning for 2023, and really setting those strategic goals is extremely important. But also understanding the marketplace. I think, as Heather talked about, it's going to be tough to generate deposits, and we should be aware of that. And it's going to be tough to generate certain types of loans. And I think so part of Craig's interest rate update gave us some feelings of where we're going to see growth and not. So really great information. You've got some red numbers, and you do know I hate red numbers on slides, right?
Yeah, they're definitely not pretty, but I think it paints a very interesting picture. So this is just showing credit union 10-year trend of total institutions. Same thing applies to banks, but we're continuing to see consolidation and a steady decline in number of institutions. So what does that really mean to me as an institution in the marketplace? Is there's more competition, you know, and there's more opportunities to consolidate within the industry.
Sorry, I jumped a slide forward there on you by mistake, but yeah, there's definitely a lot of consolidation taking place, and the pace of change is down a little bit in 2021 as the world got into this weird spot with COVID and things, but still a lot of changes. But it's not only just the number of institutions, and again, banks, you see the same data points, but you've got branches here, and you have both bank and credit union branches. This is some interesting, and institutions here, but some interesting data.
Yeah, I think what we learned in 2020 is a lot of people did a little bit of what I'll call soul searching regarding branching strategy. And we saw a shift in, you know, what future branches look like. So depending on what technology you have in your institution or should have in your institution, I think, you know, that's going to continue with the consolidation of the number of branches that we need as, you know, internet banking and mobile banking become a larger and larger theme.
Yeah, so here we have number of banks, number of credit unions, institutions, both coming down based off the right chart here, so down to 5,000 each. And then you can see credit union branches have effectively been unchanged, but this is really interesting. Bank branches, we're seeing them come down. They're down about 20% or so, 15% over this time frame. So some big declines, which is really not surprising to me. But I think this next slide of yours really highlights that reduction in bank branches really sped up post-pandemic here.
Yeah, I think this is something we'll probably continue to see, but you can see from 2019 to 21, you know, really we're having almost a double of the amount of branches closing in just 2 years. So pretty big shift, start of a trend. I think it's pretty interesting and really should have everyone taking a look at their own branching strategy to determine, you know, is this a good fit? Are we comfortable with all our locations? And what should we look at moving forward?
Yeah, it's really interesting, Dan. I was at a meeting this morning, and one of the people in the meeting said to me, "Hey, look, you know, we were at 105% of capacity of all of our facilities, you know, 2 years ago, and now we're at 60% capacity of all of our facilities." Really interesting. We really need to take a look at it and think about it and make sure we're spending some time on technology and how our customers or members use us. I mean, it's changing very quickly.
Yeah, so I think kind of encapsulating this is when we look at the environment we're operating in, you know, these are just some of the big items that I tend to look at. So one, competition, really having a thorough understanding of who's operating in our geography. You know, how are they pricing their products compared to ours? I think this is going to become especially important, you know, in the chase for deposits as those become a little bit more in demand with institutions that are facing liquidity issues. So understanding your competition that you're competing against, technology, as we mentioned a couple of times, you know, making sure we're on the forefront of technology to be able to compete against those in our local marketplace, so that we're offering at least, you know, similar type opportunities there, if not better technology. Then go ahead there.
Nope, go ahead, all yours.
I was going to say, then, you know, that also goes hand in hand with products. You know, how's our rates in comparison to our competition, and, you know, based on those, are we doing our math right? And I think that's something we can certainly help with, but making sure we're getting enough of our spread to maintain our margin on our products.
Yeah, we got to make sure we're making good earnings in everything we're doing, because we've really got to build capital. One of your points here is it's going to be one of the big challenges in the marketplace is having good capital as we enter potentially a little bit of a downturn here at the end of 2023. Okay. You know, Dan, it's interesting. Some of the things you can get with buying branches. We talked about selling branches and closing, but buying branches, buying entities, different things. You know, loan and deposit growth is something really important.
Yeah, I think looking at purchasing branches, that's a great activity as long as you have the capital and wherewithal within your institution, or bring in the right advisors to help you do so. But then, looking at what you can do internally within your own organization, we talk about the loan and deposit pricing component. Whether you need to look at new product offerings to attract loan demand if you have the excess liquidity, or really analyzing your deposit offerings to make sure you're competitive. And then what are we doing from a marketing standpoint? Are we out active in the community, engaging them, generating effectively free publicity? And then also, what other services are we offering our members? Whether that's insurance, a lot of those are kind of those non-interest income components, insurance offerings, wealth management. What more could we be doing there?
It's interesting, Dan. I was teaching a class on Monday in our industry, and one of the things the young lady brought up was that she was hired in because they're trying to get a younger demographic in the door, and she talked specifically about community activism, getting involved in the community, and actually asking what people want of the age group you're trying to bring in. It was one of those just very normal things to do, but it's not always done. So really thinking about your marketing effort to get the different activities in, or different things accomplished, I should say. So with that, when you look at what's happening with inorganic growth, things still bouncing around in the mergers and acquisition space today?
Yeah, it's an interesting place we're in. Merger activity, we're not seeing a huge decline in. These I have ranked in kind of cheapest activity to most expensive activity in terms of how long it takes you to make your money back. Acquiring branches, acquiring whole financial institutions, both great activities. The key there is having enough capital and understanding the impact from purchase accounting, or operational impact, staffing levels, what all that's going to do. And then finally, opening a branch from scratch is really the longest payback of capital, but may also be kind of one of the easier activities, as opposed to taking on an organizational change, buying stuff. But again, that comes back to that branching strategy we talked about, and making sure that fits or aligns with your future needs.
Yeah. Definitely tough to open a branch from scratch. It takes a long time. When you do acquire things, you do get the membership or the customer base, whichever it is. So you do get a number of people in the door, and it's tough to get people in the door today. So that's one way to do it. Well, wrapping up some stuff here, Dan. You've got some colorful things here. I love it.
Yeah, these are just some of the benefits, in engaging in this type of activity. You can grow your membership base exponentially, picking up a lot of human capital. That can be very valuable if you pick up some lending expertise. Ultimately, I think the main goal, though, is to drive economies of scale to better serve your members or customer base. The larger you are, the better economies of scale you have there, which is the ultimate benefit.
Absolutely. Well, in wrapping stuff up here, you did talk a bit about insurance and wealth management actives and title. These are different things people you think should be looking at the options to buy into today?
Yeah, I think you don't have to look just at, how can we grow just the core financial institution business. I think there's plenty of opportunities in the insurance space, wealth management space. You look at title companies, any of those ancillary add-on type businesses that kind of fit well under the umbrella. I think there's a lot of opportunity in those specific spaces.
Wonderful. Well, Dan, I appreciate the comments. So as we look back at your comments and then look forward to 2023, we expect that valuations business, the activity you guys do in mergers and transactions, we expect that to continue to stay strong in the merger space, but and the acquisitions might be a little bit slower given the market we're in. Is that a fair statement?
Yeah, I think it's definitely going to take a little bit slower path forward. People are going to have capital concerns, as whether they can even contemplate a transaction. But also, as losses begin to increase, I think a lot of people are err on the side of caution. So if you have the opportunity, just be prepared for it.
All right. Well, thank you very much, Dan. Well, I'm going to pause the slides here and then get rid of my screen share so everyone can see us and we can have some conversation. So thank you all for giving us giving our listeners a viewpoint of what we see for 2023. We have a few questions that have come in, and one was really interesting. It was asking the interest rate projections that we've put out there. Do we believe that there's a chance for a recession, or are we in a recession today? Craig, could you answer that?
Absolutely. I had to find the unmute button there for a moment. Sorry.
No worries.
Yeah, so the yield curve's very intuitive. I think that's one of the comments I said earlier in the presentation. And since it's been inverted for 3 months, I'm just rounding, of course, we have a recession that's looming. And, everybody's definition, we won't go down that path of what a recession is, but we're going to be in a recession, and it's just a function of timing of when it actually happens. So the Fed, they're trying to slow down inflation. That's working, but the consequence of it is slowing down an economy as well at the same time, which is going to really put us into some recessionary feeling, and it's going to happen. Just a matter of time.
Thank you. All right, another question came in. Heather, question here asks, are you beginning to see people increasing their deposit rates? And if so, by how much?
Great question. Yes, we are. Because we're seeing so much tightening of liquidity, we're having to be a little bit more competitive. So reviewing deposit rates and starting to increase those is a really important activity right now. On average, we're starting to see is about 5 basis points at a time. Some of the other more rate sensitive products, such as money markets and IRAs, may be moving a little bit wider, maybe closer to 10 or 15. But you need to do what's right for our balance sheet, but definitely reviewing those and starting to move those up a bit is going to be important. Definitely staying against competition as those deposits are running out very quickly.
Cool. Thank you. Yeah, we're beginning to see people raise rates. I would be cautious. We talked about M2 and M2 declining, money supply declining, and people are spending more money on food and gas and different things. There's not a lot of money to save. And so to me, since there's not a lot of money to save, there's money coming out of the system, it is going to be tough to garner deposits. You're going to have to steal them. And that could really bump up all of your deposit rates very quickly. So be careful. Remember, the incremental loan is just higher. It's not all loans. When you move the deposits, it's the entire pool. So a question that I want to pose to everyone here, which was one that came in a minute ago, was if you're going to get into if you are going to get into a new non-interest income activity, what would you do? And I'll answer mine. I'd love to hear the three of you, your comments, but my recommendation would get into SBA lending. To be able to take loans that you think are good loans, but maybe you're not in your wheelhouse and you want to do them, you can take that gain on sale, sell the loan, take a gain on sale, and really boost capital today. That would be the one thing I'd do if we weren't in it. Craig, Heather, Dan, comments?
Go ahead, Dan. I'll follow after you.
Sure. I'm a little impartial to involving a transaction, so I would buy some smaller, non-interest income producing business and scale it to my institution.
Love that. Not even on the list. Perfect. All right, Craig.
All right, I got 2 comments here. As one, just to add to the SBA, as we get into a recessionary environment, there will be a lot of borrowers that'll have some hiccups, that'll need to be using that conduit for financing. And so even if your institution's not into SBA, it's a good time to start exploring, investigating, bring somebody on staff that actually is good at it, because those opportunities will pick up when we get through 2023. But my favorite answer is this last few months, or last 6 months, I should say. Well, what is it? It's October. God, time's flying. This year has been terrible for the investment market, right? For equities, for bonds, for everything. It's just been, people have been crushed a little. And this is a great eye opener, because when we're once again in that low rate environment for such a long period of time, anybody could buy a stock with, just throw a dart at the board and do well. The big increase in brokerage accounts at the Robinhoods of the world and Schwab's and E-Trades. is, the wealth, the brokerage services in the lobby. This is going to be a great time for people saying, ooh, maybe I'm not a professional. Maybe I do need that help for my personal wealth and my brokerage services. So it's going to be, once again, you want to plan for the future. And I think that's going to be a great opportunity for all your customers.
All right, Heather, I got to go back to the question. I might have to repeat it, but we got a little sideways there, but it happens. What are your thoughts, Heather?
No, I agree with everything that was brought up. A lot of great opportunities in different ways. And sometimes you have to go back to basics. During the recession, we saw a lot of dropping of basic fees that we were charging and credit card transactions, things of that sort, making sure that those things are still in play, especially as credit cards have such a dependency on so many for spending right now just because of the tightening.
Yeah, I appreciate that. I think that's a great spot. Debit card, credit card, interchange income is a huge component of our income. It's not going anywhere. Craig, I do appreciate you bringing in the investments. Alternative investments in the credit union space is a great spot to get in. One would argue, I agree with your comments. Could we go down to 3,000 on the S&P 500? Absolutely. It would be another 10, 20% down, but we're getting down pretty far now. Not a bad time to start dollar cost averaging in and really getting in for a way to actually really grow capital too. That's not a bad activity. So if you're not thinking of it because of liquidity purposes, it may be something to think about. With that, I want to thank everyone here. Just to wrap stuff up as we're out of time, a couple things. These slides will be available. Please reach out to your advisor. The recording is going to be on our website, so please feel free to hop up there and grab it. It'll be on our YouTube channel, but please reach out to your advisor. They'll get it to you also. With that, our next webinar is on October 11th from 2 to 3 p.m. CECL. We're going to be going through one more time the kickoff of CECL, the things everyone needs to know, and how our new system is working, our online system, which we're super excited and proud of here. A lot of work has gone into that. So with that, as we hit the 3 o'clock hour, thank you all very much for joining me today. Craig, thank you.
You're welcome. Thanks for having us. It was just a great day and a great conversation.
And thank you, Heather. Appreciate your insight as usual.
Thank you very much. This is great.
Dan, thank you for your information, your creativity, and your answer.
All right. Thanks.
All right, guys, have a wonderful day. Thank you all very much. We appreciate the relationship and the continued business. Thank you.